Discussion forward with Pawan Parakh of Renaissance Capital, Fund Manager and Director. Pawan, afternoon. Thank you so much for your time. Pawan, let's start our chat with the point which Uday Kotak has mentioned about and touched about in his blog post today. In the banking sector, it appears that there is a fight for deposit. In fact, not only Mr. Kotak but other banks have also, in fact, in the face of potential rate cut cycle by mid or next year, here deposit rates are being hiked, FD rates, etc. So on the one hand, fight for deposits. On the other hand, if rates actually turn by mid next year, would it lead to a mid-term turbulence on NIMs for some of these large banks? Is that a risk?
So that is very clearly a risk. And I think there has been a long period where banks have actually underperformed for not only these reasons, but also for other reasons. So in my personal opinion, the potential contraction in NIMs is already factored into the stock price from here on.
Already factored in, that's good news. Let's move on then. The other point in the NBFC space, yesterday the trends report by RBI, the banking trends report by RBI seem to be nudging NBFCs to diversify their borrowing mix, in fact reducing their dependence on banks. This comes right after a month back there was a kind of a bit of a rap on the knuckles for some NBFCs are going overboard in speedo lending in consumer unsecured part. Do you think proactively NBFC would go ahead, perhaps go overseas, NCD routes, all of that, and what impact would it have on their borrowing cost?
So before we discuss this, I think it's very important to understand that here is a RBI governor, which is, I think, far more proactive than ever before, right? So if you see over the last 1 year at different points in time, he sounded cautionary in many terms, be it unsecured lending, be it increasing weightages, be it many other things. So I think all of this should be looked upon with the perspective that we are trying to avert a crisis before it comes, right? Having said that, I must also say that the entire financial system tends to obey the RBI in most diligent manner ever, right? So I would actually not be surprised if NBFCs try to diversify their borrowing sources, right? And I think from an NBFC perspective also, when they actually diversify and try to tap into new sources of funds, initially it could be some challenge for some of the NBFCs, but eventually it will be for the larger good, because essentially what would happen is that after all the initial hard work, these NBFCs would have developed multiple sources of funding, which will help in the long run.
In fact, all of these...
Of course, Venus Pipe and Ratnamani is what DAM Capital is most bullish on, but it's just not that. Look at how Surya Roshni is surging toward 20% today. Not many know they have a big pipe business. Then Man Industries up 8%. We spoke to the management. We'll get you some bites as well from there. Overall, the pipe industry, the metal pipe industry is buzzing on these figures. Do you think these are structural and it could be meaningful for half a dozen of companies which are listed here?
Yeah, I definitely concur with that view. And honestly, before we come to pipes, I must also tell you, over the last 2, 3, 4 years, the government has taken all its program very seriously, be it power, renewables, be it pipes, or be it railways, or be it defense. So all these government programs are very serious now. These are not just big numbers for analysts to just write in their report. These are things which are happening on the ground. And having said that, I must tell you, these companies have had a phenomenal last 2, 3 years, both in terms of earnings and stock price. So I definitely concur with that view that, in terms of growth outlook, these companies, the sector looks very promising. The only thing where I am a little circumspect is in terms of valuations. I think all of these companies in terms of valuations are no longer very reasonable given the rally that they've had. We might be interested in some of these names if in case we see a reasonably good correction.
Point taken. Actually change in 2024, because while urban consumption was going rara, it was the rural end of the economy that did not bounce back, and now the initial signs of it. Your take?
I think consumer, I've been mentioning it for last 6 months, is a pretty tricky space to own, because when you actually look at the bigger consumption basket, apart from staples, if you also add the discretionary side, you would see that jewelry, travel are doing well. But on the other hand, staples, consumer durables, apparels, footwear, a lot of other subsectors aren't doing so very well. my understanding from the ground is two things. One, over the last 1 year or 6 months or so, there has been some slowness as far as I mean, RBI has been very vocal about unsecured loan. Even the NBFCs are now trying to be a little cautious, and obviously retail I mean, personal loans, the personal leverage is already very high, right? And at the other hand, a lot of these cash flows are getting diverted into home purchases and jewelry, which are large ticket purchases. So in the mix of all this, I would want to believe that some of the sectors which haven't done well over the last 6 months or so, primarily the stable space, will continue to struggle actually, because there is no reason for a big bounce back into these sectors. And if you add to that, despite these stocks haven't not doing so very well over the last 2 years, so valuations are still not very comfortable as far as we are concerned. And that is the reason, I mean, actual is the point that we discussed in last 2-3 minutes or so. But we are witnessing this trend across the entire staple space, wherein companies are trying to, be a little aggressive with the channel, and trying to drive more volume growth, so that it can support their earnings or so. So overall environment on the ground isn't looking so very rosy, and we would actually try to stay away from these stocks because both from earnings perspective and valuations, we aren't so very comfortable out here.
Okay, point taken. So not bet for 2024. If you can pull up a stock or a big theme, what comes to mind?
I think banks have been a big underperformers. There have been a lot of cautionary statements from RBI. I would want to believe that India's got a very strong banks have got a very strong underwriting skills. Consumers have become very cognizant of their credit scores. So growth will continue, and we are unlikely to see any major issues as far as NPAs are concerned. These stocks haven't done anything in last 2 years or so. So banks is definitely one space which I think should recover, bounce back in the next calendar year. Apart from that, I think capex cycle recovery is a theme which is very strong out here. So industrials, infrastructure is another theme which we think should continue to do well. And when I say that, I also include a lot of these allied spaces like power ancillary, defense kind of stocks. So if you were to ask me top two names, I think these are the two key sectors which I feel there's a reasonable good comfort both in terms of growth, earnings growth, and valuations.
Fair enough. Banks like this and the other, agro sector, cotton, textile for that matter.
Not so very in great depth, honestly. These are kind of cyclical sectors. I mean, I must tell you, specifically to sugar, the space looks interesting because ever since government has started using ethanol as a balancing factor for sugar earnings, the sector's cash flow, earnings, visibility in terms of growth, in terms of cash flows have become very high. And that is the reason you would have seen some of these stocks doing well. I would want to believe that if these things continue, there's a reason to believe that valuation can even improve from here on.
Okay, point